Okay. So, now let us try to understand about flexible budget in an example of Starbucks Corporation. So, the company is planning to sell 1 million cups of coffee at a price of $5 each, making it $5 million in revenue. The variable cost per cup is $2, having the coffee beans, milk and cups, so making it $2 million. The fixed cost for the company is $2,500,000, making like rent, salaries, marketing and other expenses. This gives us the contribution ratio of 60%. So, this contribution is simply the sale value here minus the variable cost, that gives us $3,000,000, and when we divide this $3,000,000 with $5,000,000, let me just correct it, when we divide this $3,000,000 with $5,000,000, then we get 60% of contribution margin. And then if we reduce this fixed cost of $2,500,000, then we get our operating income of $500,000, which is given here just like this. Now, in actual what has happened, company has sold 900,000 cups instead of 1 million cup, and the average price cup was for $4.8 instead of $5. So, the total revenue for the company is $4,320,000 in revenue. Actual variable cost is around 2.2 per cup instead of $2, which means the variable cost per cup is higher here, and the actual fixed cost is 2.6 million instead of 2.5 million, because there may be higher rental, utilities or marketing expenses. Now, we need to create a flexible budget based on this. So, we can simply say that what are our actual results. So, we write our actual units, which is 900,000 cups, and what is the sale value from them, which is $4,320,000, which is here, and what is our variable cost, we write it as $1,980,000, and that gives us the contribution margin of sales minus variable cost, gives us the contribution margin of 2.34 million here, and we are having our fixed cost of 2.6 million here as well. That finally gives us the operating income of $260,000 in actual. Now, in reality you know that whatever is the variable cost that will be incurred $2.2 on these 900,000 cups, right. So, we need to prepare a flexible budget for that. So, what we can say that for 900,000 units, that sale value would have been, now I am saying would have been, why I am saying would have been, because this $900,000, not the dollars, 900,000 cups, if we sell them, then the selling price for them would have been $5 each. So, if the price for them would have been $5, then what would have been the total sales value? So, this is giving us the number which is 900,000 multiplied by $5, which was in our planning. So, how does this flexible budget is working? In actual, we are having the same units here actual, and we are revising our budgeted number of units based upon actual. Budgeted units were our 1 million cups, but in flexible budget we are saying we are having 900 cups only. Now, these both of them are comparative and we can compare their cost. So, this is our sales. Similarly, if we go for our variable cost, we say that the variable cost per cup would have been $2, and so for 900,000 cups what would have been the variable cost. So, we will simply do 900,000 multiplied by $2, making it 1.8 million. This gives us the contribution margin of 2.7 million, and we say what would have been our fixed cost, which is in our master budget. Now, fixed cost is fixed irrespective of number of units. So, we are not focusing on units here, and that finally gives us the operating income of $200,000 here. So, our budget was here for $200,000. Now, what we need to do? We need to simply go and see the variance. So, in sales, if we see, there we planned was for $4.5 million, but we actually did $4.3 million, making it an adverse variance of $180,000. Right, you can see $180,000 adverse, the difference of both of them. If we see the variable cost, we planned that the cost to variable should be 1.8 million, but here it is 1.9 million. So, again the variable cost is having $180,000 of adverse situation for them. On the other side, if we see our contribution margin, we planned it should have been 2.7 million. However, this is only 2.3 million. So, there is an adverse contribution margin of $360,000 here as well. The difference of fixed cost, we planned 2.5 million cost, but in actual the cost is 2.6 million. So, $100,000 million is the adverse fixed cost variance here, and in effect overall our total operating income variance was $460,000 here. So, this is our total I can say impact of variance. Now, if we can further break these variance into volume variance and price variance as well. So, let me just go below and see the interpretation of variances for you. So, in the flexible budget variance, we can say sale price variance was like instead of planning $5, we have sold at $4.8 here. If you can see, we planned for selling at $5, but we sold for $4.8. So, what might have happened? There is an adverse thing for you, right? So, what you will be saying, there is an adverse thing for you for how many I can say dollars. So, you can simply say 4.8 was your actual and 0.5 you planned for. So, there is an impact or adverse impact of 0.2 dollars, and if you multiply that with the actual number of cups, because that loss which you have incurred is on actual number of cups, which is $900,000 cups, then that gives you the number of total loss, which is $180,000 here. You can see that impact, right, $180,000. Similarly, if we see our variable cost impact, so we planned that variable cost should be $2, but in actual it was $2.2. You can see here we planned $2, but actual it was $2.2. So, effectively what you can say that we planned for 2, but in actual it was 2.2. So, we are bad again by 20 cents here, and in actual we sold 90,000 cups. So, on 90,000 cup, not 90,000, 900,000. So, we sold 900,000. So, in effect we are adverse by $180,000 if you multiply these two numbers. So, this will be your variable cost price variance. In the case of fixed cost, the number of units does not matter, that is simply the differential. So, here the fixed cost we planned was 2.5 million, but actually we did 2.6 million. So, the differential is $100,000 for the fixed cost, which is shown here. And finally, the net effect is like if you take into all these accounts, then you will have 460,000 unfavorable impact on the price, right. So that you know as of now. Now if we see the volume variance here, so you planned for 100,000 cups, but you sold only 90,000 cups. So you can say not 90,000, let me just correct it, 900,000 cups you planned for, actually you sold, but you planned for 1,000,000 cups. So effectively you have sold lesser cup by how much? You can say we have sold lesser cup by 100,000. Now if the lesser cup you sold, it will have the impact on your sales revenue, right. So how it will impact your sales revenue? So you can say on these cups I could have earned a contribution margin of how much? You can say $5 was my selling price, $2 was my variable cost. So on these 100,000 cups I could have earned a contribution margin of $300,000, but I am unable to earn that right now. So due to selling of fewer cups, there is a loss of $300,000 due to unfavorable, I can say, volume here. So this is the sales volume variance. Now finally if you want to compare your master budget with actual, you can also do that, but overall this was here for your variance, and this was your flexible, I can say flexible variance, which you saw here as 460,000 unfavorable. This can be understood in detail because there will be a separate sections within the course where a more detailed description will be done. So I believe on a very high level you got to know that what does it mean. Now how does this help management for the insights? So Starbucks lost both on volume because their volumes are lower, because there may be lower customer, or there may be good competition or seasonality, and performance, their price was also low and their cost was also high. So all the things were not in their favor. Flexible budget reveals that even if only 900,000 cups had been expected, companies still underperformed, because even if the cups are lower, the company is not doing good. So price was cut too aggressively, that has caused the revenue shortfall, because from $5 you sold it at a lower price. Ingredient cost increased like a coffee milk inflation. So your variable cost has increased from $2 to $2.2, and finally fixed cost has also been increased, because it may be possible that you hired certain new people or new marketing campaign or some other areas. So overall this was about the variance analysis. This will be discussed in a more detailed fashion in a separate section within the course. However, for now let us end this section.